Hello class, welcome to our 11th lecture series on international finance. I'm your instructor, Jamal Haider. So before starting our today's lecture, let's talk about our assignment because I'm getting a lot of messages regarding the assignment that it's a little bit difficult or challenging, or some students they don't know the scenarios, this kind of stuff. So let me just read the question and explain the solution here. So, and also I will be giving you some hints on how you are going to solve these kind of questions. So if I can have, yeah, here we go. So let's talk about the assignment solution here. So question number 1 relates to basically the forward contract. So let's just read the scenario. So Lucky Cement Incorporation, a US-based MNC, will need 10 million Thai baht on August 1. It is now May 1st. So Braxton is hired as finance trainee. His boss has negotiated a non-deliverable forward contract with its bank. So what is non-deliverable forward contract? In which this 10 million baht is not actually transferred to his account or the parties. Only the differences in the expected spot rate that would be in future and the forward rate or future rate, the difference is going to be traded. Okay, so it means in non-deliverable contract, this serve as a reference amount. Okay, so the reference rate is the baht closing exchange rate in dollars quoted by Thailand Central Bank in 90 days. So now we know that this is the 90-day contract. So how you are going to make a timeline? So whenever you use these kind of derivative questions, make a timeline because that is going to help you a lot. So this is May 1st. So you can just write down May 1st. So you are right now here, and this is total 90 days, right? 90 days. And reference rate is, you just write it down 1 million. I'm just writing down 10 million, 10M. So the baht spot rate, it means today, spot rate today is $0.02. We just write it down here. It is $0.02 here, right? You are right now here. So Braxton is given assignment to analyze what happened if the rate quoted by Thailand Central Bank on August 1 is 0.022. What is this? Is this future spot rate or this is what? No, again read the question. Braxton is given the assignment to analyze what happened if the rate quoted by Thailand Central Bank on August 1 is 0.022. It means this is spot rate at 90 days, 0.022. So Braxton is not sure about the solution, whether Lucky Cement Incorporation will pay or receive amount and how much. So that's why we enter into non-deliverable forward contract, right? Because we don't know whether we receive or whether we pay, right? So since you're in his classmate, so he has contracted you and asked your help in this regard. So solution is here. So here, did you notice something, that one thing is missing? And that is future rate, right? Right, they enter into non-deliverable forward contract. And what is the nature of forward contract? You must have two parties, buyer and seller. You must have reference point, and you must have future or forward rate. So if this kind of question occurs, assume the 90 days spot rate is your forward rate, right? And now normally these type of questions are like that. The bank forward rate and the bank's prediction is quite right. Just remember this one, in which bank's predictions are quite right. So it means this is the forward rate as well. So no matter whether you are on May 1st or whether you are on May 90, you would be judged based on forward rate. Since question is out of future rate or forward rate, so we will be closing our deal on spot rate, that is on 90 days. So what is the difference? So difference is that how much he need to pay or he need to receive. So he enter into a contract, and that contract is okay. The question is a little bit okay, yeah. Question is a little bit also fishy here, because we don't know whether we are paying or whether we are receiving. So we just are required to answer based on so this number is telling you nothing. The difference is 20,000. I'm sure you know how to do that. Spot rate in the future minus spot rate current, the difference multiplied by the 10 million, answer is 20,000. So here, this scenario is basically a little bit fishy, because question itself, we don't know the future rate, we don't know the forward rate, plus we don't know the strategy, whether we purchase at the end or whether we receive at the end, right? In that case, you are only required to calculate the answer. So this answer 20,000 is telling you what? Whether you pay or whether you receive, nothing. Just the answer. If the scenario is molded like that, okay, they need to pay at the end, then scenario will be that, okay, and future rate going to be mentioned, then that would be a scenario for you to answer. So this is just for you to how to calculate, how to operate the forward and future contract. Okay, so your confusion is justified. I intentionally did that, I know, just to give you the taste how in real life examples, how much confusing these future and forward, because it's not like a 2 plus 2 is equal to 4. In real life, it's very complicated. Plus you need to do it in matter of seconds or matter of minutes. So this is how hard it is when you are having 10 millions and you are having a loss or income of having $20,000, because you cannot earn $20,000 in 1 month. Your salary is just for $4,000 or $5,000. So on one click, it can be a loss and can be a profit. So these kind of decisions require strong mental capability and mental, effectiveness as well. You need to be very strong with taking your nerves as well. Okay. Question number 2, let's talk about this. So Niels, Jaron, and Jordan, the financial consultant, gave financial advice to Nestle, a US corporation. So to purchase call option, now this is purchase call option, right? To hedge 70,000 pounds payable. What does it mean? So they want to pay, right? So that's why they purchase call option. Okay, understand? So they explain the benefits of using call. Okay, the company first need to expect the offer and want to test this first. So the premium is 0.02, right? So how much they pay on pounds? 70,000 pounds multiplied by 70,000. So that is their premium. Okay. Exercise price or strike price is at the end of the expiration of option. If they want to exercise the option, they will be purchasing the pound at $0.5. So it's like that. So we don't know the time period, okay? Don't worry about that. But we know that this is, if this is the time, so expiration date is exercise is 0.50. If you are right now here, right, and you have to pay premium, we denote it with C because this is a call, and premium is 0.02, right? So if the spot rate at the time of maturity, which is, if you are here, that maturity is 0.65, and you are paying, right? So it's a benefit or it's a loss, right? It would be a benefit to exercise call option. Why? Because if you buy from the market when the spot rate is about 0.65, pound is expensive, right? But what did the question says here? So what is the total amount paid by the corporation if it acts rationally? Which means they want to test it first, right? The company accept the offer and wants to test it first. And what does it mean? It means how much cost, it is to basically pay for 70,000 pound. Answer is simple. How much is the cost? They will purchase, they will purchase the 70,000 pound at 0.5. So the payment price would be 35,000, and premium price on every pound you pay 0.02, you multiply it with 70,000. So what is your cost? $36,400. And what if this question tells you how much is the profit? So this is your cost. Your profit would be 0.65. You buy it from this supplier if the scenario is like a different one and you are speculator. So in speculation, what you would do, you will buy from this, you will exercise the option, you already paid. It's not like that you will pay. No, you already paid. When you enter into an option contract, you already paid this premium, and that is your cost. So you exercise the option, at the end you buy at 0.5, you sell it at 0.65, you buy at 0.50, and you already paid 0.02 premium. So the difference would be you multiply with 70,000, that would be your profit, right? So the question is just to find out how much they pay. So this is the cost. Question number 3. HSBC Bank is expecting to receive, so they are receiving British pound, 100,000 British pound. So HSBC expects the spot rate. So remember, we are talking about future spot rate at expiration, right? So pay very close attention to different words, to your picky words, that whether this would be a spot rate today or whether at the expiration, right? Yes.
Sorry for the question too. So the correct answer is 36.40, right? If they act rationally, they will take the call option, right?
That is the cost of our call option, yes. 36,400, not 40, 400. 1,400 you pay commission, and exercise price gonna be, you will spend $35,000 to buy pounds, 70,000 pounds.
Okay.
Okay.
Thank you.
So pay very close attention to the word expects, which means that would be your expiration. So, okay, spot rate of British pound is 1.49 in a year. So it decides to avoid exchange rate risk by hedging its receivable. So for this purpose, you hired a team from CIP. Glad you are in international finance, so you are the team. So the current spot rate is 1.51.